Now, Slovenia could become the next Eurozone country forced to request a bailout. This is according to investment bank Nomura, which says the country's banking system in many ways mirrors that of Cyprus. Not particularly good news. The government is facing a dangerous fiscal balancing act. Peter Attard-Montalto is emerging market economist at Nomura International, and he joins us now. Peter, what are the chances here? How big are the risks of Slovenia following Cyprus?
Well, the Slovenia story really is quite interesting because in one sense it's quite different from Cyprus. They haven't asked for a bailout, and obviously Cyprus asked over a year ago for a bailout from the EU. They are resisting for the time being. But similar to Cyprus, this is really a banking sector problem as opposed to a fiscal problem. And the real worry here is that actually on its own, if the government still has access to the market, it could possibly navigate this without a bailout, but will, as we've seen in the past, the market turn towards Slovenia and prevent it from funding itself, and from there you get a self-perpetuating crisis. So that's why we highlight the risk of Slovenia as the next in line.
You point this very clearly. You just mentioned there. You point it very clear in your notes. If they ever wanted a loan, it would be purely for the banking sector, not for the sovereign itself, and that's a key difference.
Exactly. They already have a program in place of fiscal consolidation, some budgetary reforms, structural reforms in place. So again, that's not really where the focus is. It's around dealing with about 7 billion euros of bad debt on the bank's balance sheets. And the history, of course, is that the population rejected a referendum a couple of months back in order to set up a good bank, bad bank scenario that could deal with the problem. And that has therefore required extra money to come from the government. And they'll have to get that from somewhere and from the market, and hence the risk and why it all comes back to funding. But no, the government's clear that whilst they're not requesting a loan at the moment, if they ever did, it would only be for the banks.
Yeah, what is happening on the politics there? Because we had Janš's government collapsed at the end of February. The new government's clearly going to be slightly more populist, which I guess means the debt is going to get worse in the short term. What's the danger of the new policies not working out?
Well, if we do have a new Prime Minister, I mean, she won a no-confidence vote yesterday and therefore is now forming a cabinet to take policies forward. I'm not sure that fiscal slippage is necessarily a huge risk. It's not quite like some other countries like Bulgaria where that sort of thing under a new government is a very severe risk. But it's more about how they want to deal with the banking sector crisis. And there have been a lot of mixed messages about if they want to reject the outcome of that referendum on the use of a good bank, bad bank solution. That's really her main first challenge going into her term.
The banking sector. How does the banking sector, though, in Slovenia compare to the size of the economy as compared to the extraordinary size of the banking sector to the Cypriot economy?
Well, it is so small, certainly the percentage of GDP. In Cyprus, it's about 800%. In Slovenia, it's about 145%. So quite a bit small compared to the size of the economy, but still very large loan-to-deposit ratio. And similar to Cyprus, is the interesting point, still quite a low proportion, actually, of the assets of the banks are funded by wholesale debt. And therefore, deposits are still one of the main funding mechanisms for the banks there.
Peter, I know a number of people have obviously been making comparisons between Cyprus and other nations around the Eurozone, and I appreciate this might not quite come in the emerging market section, but any thoughts of any of the other nations that you think have got similar scale of banking system relative to the economy that might have issues? I know people kind of making some facile comments about Luxembourg earlier, but any thoughts about anybody else that might be slightly exposed?
Well, I think elsewhere in the Eurozone, it's much harder to identify who would be next after, if you think of Cyprus and Slovenia. I think people are certainly looking much more towards outside the Eurozone in the EU still, and places like Hungary that have very large exposures still of FX mortgages, similar problems in some countries in Southeast Europe as well, such as Bulgaria, people questioning around Croatia as well. So inside the Eurozone, I'm not sure there's necessarily anyone particularly to look after Slovenia.
What about, in terms of future bailouts, of course, the thing about Cyprus is if they do get a deal done, it may well still involve taking deposits, a cut of deposits. Now, they always say this is a one-off, but it doesn't mean that if there was going to be a programme for Slovenia, that people won't think about that if they were to go into a bailout programme. So how does that now sort of change the thinking?
Well, exactly. I mean, given that Slovenia, like Cyprus, to some degree has a lower level of wholesale funding of their banks compared to, say, others like Poland or South Africa that have a much higher rate, that question will come up. And a lot of investors are asking that over the last couple of days. But I think we have to remember the political dynamic is totally different around Slovenia versus Cyprus. You don't have the same problem of Russian oligarchs and corporates holding debt there, or holding deposits rather, the need to write those down and not be seen bailing them out. So the mood, I think, if it were ever to come to it from Germany and from the opposition in Germany, would be very different and more supportive, if you like, of a normal bailout as opposed to necessarily needing to consider the use of deposit write-down.
Peter, good to see you. Thanks for that. Have a good weekend. Peter Attard Montalto, emerging market economist at Nomura International.